All right, let's talk a little bit about these three different classifications of assets. I could say trade or business. Business assets, property. So these three classifications, again, it determines how gains or losses on the sale are reported for tax purposes. Also determines whether or not, well, land's not a good example because we don't depreciate land, but the type of asset, how we're using it, also determines whether we're going to depreciate it or not. So, for example, if we have a copier that is used in our business, we're going to depreciate that copier. If the copier is just our own personal use copier, we have it at home, we use it for our personal, whatever we're doing at home, that now becomes a capital asset and we're not going to depreciate it, right? If we have a copier and we sell copiers for a living, now it becomes a piece of inventory and it is included under an ordinary asset. Again, we're not going to depreciate it because it's a piece of inventory that we're just selling in the regular course of business. And that's another illustration of how the asset itself, the classification of the asset itself and what it is, doesn't determine which category it falls under. How we use it and what our intent is what determines it. So the first thing that we want to talk about is ordinary income property. So ordinary income property is, as they state here, under the tax code, essentially the definition of an ordinary income property is just anything that's not a capital asset, which is a pretty broad definition. So we're going to define it a little bit more specifically. It's going to be a short-term asset used in a trade or business. What is short-term? So short-term trade or business. So short-term trade or trade or business asset, which means it's less than 1 year. So we've owned it for less than 1 year. Or actually, I think it's 1 year or less. So I sometimes mix that up. I think it's 1 year or less. 1 year or less. So we bought a copier, what's today, is October 14th. We bought a copier on October 30th, 2024, and we sell it today. That is a short-term asset, short-term trade or business asset if we're using it in our business, right? So we've owned it for a year or less. Now it's an ordinary asset. When we sell it, we're going to treat it under those ordinary asset rules, okay? Inventory is considered an ordinary asset. That makes sense. Go back to financial accounting. Inventory shows up as an asset on the financial statements, right? On the balance sheet. That is an item of, or that is an asset. It's a short-term asset. We sell inventory. We may sell inventory just in the course of business. If we own a clothing store and we purchase clothing to then resell, that clothing is considered an item of inventory. The sale of that inventory is in the ordinary course of business, but we could also sell inventory outside of the ordinary course of business. Maybe we have a bunch of extra clothing from the year before and we've bundled it together and we're going to sell it to another store for a package, a package deal because we want to get it out, right? So that's not really in the ordinary course of business because we're not selling it to a customer, but we're packaging it together and we're selling it to somebody else so that they can then resell it. But it would all be considered a ordinary income asset. Accounts receivable are also an ordinary asset. And here what we're talking about is, because when we accumulate accounts receivable, we've sold something and somebody hasn't paid us yet, right? what sometimes businesses will do is they will sell their accounts receivable to somebody else, and that other person then collects on them. So like a collection agency, maybe you have customers that owe you $10,000, and there's a collection agency that comes along and says, hey, we will collect that. We'll give you $5,000 right now, and we'll collect the $10,000. So you're selling your accounts receivable to that collection agency. If you were to collect those funds in the regular course of business, it would be considered an ordinary asset that's your ordinary income that you just earn in the regular course of business. So the fact that you are selling it to somebody else means that it's going to be treated exactly the same as ordinary income. And then also notes receivable under the same category. So if you have any notes receivable that you sell to a third party, that sale is considered to be ordinary income asset sale. The next category is capital assets. These are essentially investment and personal use assets. But for personal use, we only report gains. We don't report losses. So, investment. I buy some stock in Apple. I pay $1,000 for it. A couple years later, I sell it. I sell it for $2,000. That was an investment. I wasn't doing anything else with it. I'm just buying something hoping that it's going to go up in value, right? I've made an investment in it. Personal use. My personal car. The car that I drive here every day. The house that I live in. The furniture that I own in my house. All of that stuff is personal use property. Investment property and personal use property, investment assets, personal use assets are all considered to be capital assets. Now, I put here only gains because when you sell a personal use asset, believe it or not, if you make money on it, you're supposed to pay tax on that. So if you buy a car say you buy a classic car for $10,000 and you resell it for $12,000, even though it was just yours, maybe you drove it for a while, but because it's a classic car, it actually increased in value, that $2,000 gain is taxable income. But if the opposite were true, which is what happens with most of our cars, you buy it for $10,000 and then it goes down in value, when you sell it, you don't get to take a loss. You don't get a tax benefit from any losses for personal use property, only gains on that. Essentially, a capital asset, personal use, any investment property, it's not inventory, not depreciable trade or business property, not a copyright, not an accounts receivable, not a notes receivable, but investment or personal use property. Last category are trade or business property. These are long-term. So we've got short-term up here, long-term, depreciable, trade or business property. So again, long-term. So that copier that I talked about up here that I bought it October 30th of last year. I'm going to sell it today of October 14th. Well, now I bought it September 30th of last year, and I'm selling it October 14th of this year. Now it's been held for more than 1 year, and I used it in my trade or business, and it's depreciable property. Also, long-term land used in a trade or business. Has to be used in a trade or business. Remember that if it was investment land, it would be up here as a capital asset. If it was a piece of inventory, so I subdivide that land and sell it, and it's a piece of inventory, now it's an ordinary asset. So this is long-term land used in the trade or business. Not short-term trade or business property, not inventory, not a copyright. All right. So again, long-term. If it was a short-term asset, so if it's land and we've owned it for less than a year, it's going to go up here under ordinary assets. So those are our three categories here. So let's talk a little bit about, in more detail, about these ordinary assets. Inventory, I already talked about inventory. Receivables, accounts or notes receivable acquired in the ordinary course of business or from the sale of any inventory properties. Typically, the sale of inventory is going to appear on the income statement of a business as cost of goods sold. Typically, if you're selling it just in the regular course of business, remember on that Schedule C, we have a cost of goods sold section for items of inventory. That's where it's going to go as well. If it's just in the ordinary course of business. So you sell clothing as your business. Every time you sell a piece of clothing, you're going to cost the inventory that you just sold, right? And it's going to show up on that Schedule C. So gross profit, sales minus cost of goods sold, is ordinary income subject to tax entered on Schedule C for a sole proprietorship. The collection of an account or a note receivable is also ordinary income to a cash basis taxpayer when that cash is collected. Neither selling inventory nor collecting accounts or notes receivable requires anything special as long as it's in the ordinary course of business. Now, if that, like I said, if that inventory, and you're going to see an example, I think, here later, where there is inventory that is sold that's not entered on the Schedule C, it's entered in a different place because it wasn't sold in the ordinary course of business. But for the most part, what we're just talking about here is just our ordinary income. Everything is going to show up in Part 1 of the, on that Schedule C, right? All of our income. That's it. And we call it ordinary because it's taxed at ordinary tax rates. Those original tax rates that we talked about in chapters 1 and 2, all of those ordinary, usually higher tax rates, right? Depending upon the tax bracket that you're in. All right, so what about capital property, capital assets? Capital asset is any asset used for personal purposes or for investment, okay? So investment in stocks or bonds is the common example of that, but other types of assets would be a home owned and occupied by the taxpayer, timber grown on home property or investment property, even if the taxpayer makes occasional sales of the timber, household furnishings, car, your personal car, coin and stamp collections, gems and jewelry, gold, silver, and other metals. So as it mentions here, the Internal Revenue Code defines it by what it is not. It is everything, includes all assets held by the taxpayer except if it's held mainly for sale to customers, which could include stock in certain instances, inventory and other property held for sale to customers, property used in a trade or business that is subject to depreciation or that's not subject to depreciation, like land, copyright, literary music, artistic composition, those things, accounts or notes receivable, acquired in ordinary course of business, real property used in the trade or business, and some other rather specific items. Supplies used or consumed in the ordinary course of a trade or business, those prepaid, that remember those like supplies and things, you would account for those on the balance sheet as a prepaid asset, right? So anything essentially, it's not in a trade or business. So you can see this stuff up here refers to items that are in a trade or business. Down here as well, trade or business. This is all the stuff that's really not in a trade or business. Okay. So there's some special rules for musical compositions. I don't know that I'm going to go through that. I don't know if I want to go through that or not. Well, artistic works are specifically not capital assets of the taxpayer who created them. So if you're an artist, and let's say you create paintings, and you sell your paintings, because you're the artist, that is considered to be, and when you sell it, it's considered to be an ordinary asset. The person buying it, though, when it changes hands, most likely it is going to be considered a capital asset. Maybe they bought it thinking it's going to go up in value, or they're just going to hang it in their personal house. They like it; they're going to hang it in their house themselves. Now it's an investment piece of investment property, and it becomes a capital asset. So for the artist, the one who created the piece, it is a piece of inventory that they're selling. So the basis is going to change as well. So if it's a piece of inventory, when you sell it, your basis in that is going to be the cost of the supplies, the canvas, the paint. That's pretty much it. That's your basis in that painting. But for the person who's purchasing it as a capital asset, their basis is going to be whatever they paid you for it. So maybe you spent $20 on paint and $100 on the canvas, and you sold it for $1,000. Well, your basis in that was $120. So whatever, that $1,000 minus the $120, that's your gain on it. But for the person who is purchasing it, their basis is the $1,000 that they paid for it. Let's see. So we got Jacques, world-renowned artist, painted a lovely new work. He gave the painting, now it's a gift, to a close friend as a gift. Because the property is a gift, the friend's basis is going to be the same as Jacques' basis. So whatever it cost him to create it, right? Cost of the canvas and the cost of the paint or whatever supplies he used. Consequently, the painting is not a capital asset to the friend and would be treated as ordinary income property. Because it was a gift, it's going to retain its characteristics to the recipient that it had to the donor. Right? So that's capital assets. We've gone through ordinary assets, capital assets. Let's talk about trade or business assets. All right. These are depreciable or non-depreciable property. So long-term depreciable or long-term land, that would be our non-depreciable property, that's held for more than 1 year. Land that's held, land purchased and held for investment is a capital asset, though. Land purchased and held for resale as a piece of inventory would be considered an ordinary asset. So timber, coal, all of this stuff, certain livestock, are also considered trade or business property, so 1231 property. Most typical examples are things like machinery and equipment that's used in a business, business buildings, and business land, right? So if we were a business, all of these computers, if we've owned them for longer than a year, all of these computers, all the tables, all the chairs, the building that we're in, as long as it's owned for more than a year, it would be considered 1231 property. If a business asset is disposed of within a year, it is treated as a short-term asset, and it is considered to be ordinary income. 1231 assets do not include property that is considered inventory or artistic works. Okay, so here we've got Vlad, sole proprietor, purchased a 3-acre lot for $55,000. He constructed a building for the business on a portion of the land, used the rest of the land for customer parking. The land, building, and the pavement are considered to be 1231 property. As long as it was owned, it was used for more than 1 year. Okay, let's see. So we don't have the... So just as an aside, to report ordinary income or loss from the sale of an ordinary asset, that's not in the regular course of business. So it's outside of the regular course of business. We use that form 4797. We'll take a look at that probably on Thursday. kind of take a tour of that form. You include the description of the property sold, the date acquired, date sold, and the sale price, depreciation allowed, cost basis, and the gain or loss. It's all included on that 4797. Again, it will be taxed as ordinary income. It will be taxed under ordinary income tax rates, but because it's not sold just in the ordinary course of business, but just by the fact that it is an ordinary asset, it's going to be reported on the 4797. Okay. All right.